Before we dive in, it's crucial to state that this video is for informational and educational purposes only. I am not a licensed insurance agent or financial advisor. The information provided here does not constitute financial, legal, or insurance advice. You should always consult with a qualified professional before making any decisions about your insurance coverage. The details of policies can vary significantly by state and provider, so please use this presentation as a starting point for your own research and professional consultation. Picture this: a freelance graphic designer, let's call him Mark. Mark is having a great year. He's landed a few big clients, and his business is finally taking off. He drives his personal sedan to client meetings, to the print shop, and to networking events. It's his car. He pays his personal auto insurance on time every month. One afternoon, he's driving home from a client presentation, his laptop and portfolio in the passenger seat, when someone runs a red light and T-bones his car. It's a bad one. The car is a wreck and Mark has a broken arm. But he thinks, okay, this is terrible, but that's what insurance is for, right? He calls his insurance company. He explains what happened. The agent on the phone is sympathetic, right up until Mark mentions he was coming from a client meeting. A pause. The agent asks, "You were using the vehicle for business purposes?" Mark says, "Well, yeah, I was just driving home from a meeting." And then he hears the words that every small business owner dreads. "I'm sorry, Mr. Evans, but your personal auto policy does not cover accidents that occur while the vehicle is being used for commercial purposes. We can't approve this claim." In that single moment, Mark's world collapses. Not only is he facing thousands of dollars in medical bills and the total loss of his car, but the other driver is now suing him for their injuries and damages. And his insurance, the safety net he'd been paying for faithfully for years, has just vanished. He is completely financially on his own. This isn't a scare tactic. This isn't a one-in-a-million horror story. This exact scenario plays out every single day across America, bankrupting freelancers, crushing small businesses, and destroying livelihoods. And it all stems from one of the most common and dangerous misunderstandings in the world of entrepreneurship: the massive critical difference between personal and commercial auto insurance. That is why you are here. This video is your definitive guide to navigating this minefield. We are going to pull back the curtain on commercial auto insurance, explaining exactly what it is, why you almost certainly need it if you use your vehicle for any work-related activity, and we're going to put one of the biggest names in the industry under the microscope: AAA. By the end of this series, you will have the knowledge and confidence to protect your business, your assets, and your future from the single mistake that could take it all away. So if you are a real estate agent showing properties, a contractor hauling tools and materials, a caterer delivering food, a rideshare or delivery driver, a consultant visiting clients, or even just an employee who runs company errands in your own car, you need to listen closely. This isn't just about ticking a box. This is about survival. The fundamental misunderstanding comes down to one word: risk. From an insurance company's perspective, risk is everything. Your personal auto policy is priced based on a predictable low-risk profile. They calculate your premium based on you driving to the grocery store, to your kids' soccer practice, maybe commuting to a single office location. The car is on the road for a predictable number of hours, in familiar areas, carrying nothing more valuable than groceries or family members. But the second you start using that vehicle to make money, the entire risk equation changes dramatically. Suddenly, you're not just a commuter, you're a commercial operator. You're likely on the road more often, during peak traffic hours, and in unfamiliar locations. You might be carrying expensive equipment like Mark's laptop and portfolio or inventory, or even other people, passengers who represent a huge liability. You're making frequent stops, navigating busy commercial districts, and you're under the pressure of a deadline. To an insurer, every one of these factors screams higher risk. More miles, more stops, more valuable cargo, more potential for something to go wrong. And when things go wrong in a commercial context, they go wrong in a much bigger, more expensive way. This is the core reason your personal policy has what's often called a business use exclusion. It's written right there in the fine print most of us never read. The policy is designed for personal, pleasure, and commuting use only. The moment you cross that line into commercial use, in the eyes of the insurer, you have violated the terms of your agreement. Your coverage can be voided instantly, right when you need it most. It's like bringing a garden hose to a warehouse fire. It's the wrong tool for the job, and the consequences are catastrophic. So what then is commercial auto insurance? Think of it as a suit of armor built specifically for your business on wheels. It's designed from the ground up to handle the higher risks and unique liabilities of using a vehicle for work. It doesn't just cover your car, it protects your entire business. While it shares some basic similarities with a personal policy, like liability and collision coverage, it offers higher coverage limits and specialized protections that a personal policy could never touch. For instance, commercial policies can cover vehicles that personal policies won't, like work vans or pickup trucks with modified equipment. They can cover employees who drive the company vehicle. They can provide coverage for hauled equipment or transported goods. The liability limits are a key differentiator. A typical personal policy might have a liability limit of $100,000 or $300,000. That sounds like a lot until a business-related accident results in a serious injury, and you're suddenly facing a lawsuit for $2 million. A commercial policy is designed for these high-stakes scenarios, offering liability limits of $1 million or more, creating a crucial firewall between a lawsuit and your business's bank account, or even your personal savings and your home. This isn't an upsell. It's a necessity dictated by the world we live in. One bad accident in a work vehicle can generate lawsuits that would instantly overwhelm the limits of a personal policy, leaving you personally responsible for the rest. That's the difference between a bad day and bankruptcy. And that's why we need to talk about what companies like AAA are offering to bridge this critical gap for business owners just like you. So when we look at AAA, a name most of us associate with a flat tire on the side of the highway or a family road trip map, the idea of them being a major player in the commercial insurance space might seem unexpected. For decades, they've been the trusted guardian of our personal vehicles. But that very trust, that reputation built over a century of service, is precisely what they're leveraging to protect not just our family sedans, but the vehicles that are the lifeblood of our businesses. Who is this for, really? Is AAA's commercial auto policy designed for massive trucking fleets with hundreds of 18-wheelers? Not typically. Their sweet spot, where their coverage truly shines, is for the small to medium-sized business owner. Think about the local heroes of our economy. The electrician whose van is a mobile workshop, filled with thousands of dollars in tools and wiring. The catering company with a couple of refrigerated vans, delivering for weddings and corporate events. The real estate agent whose SUV is essentially their office on wheels, shuttling clients from one property to the next. Or the landscaping crew with a pickup truck and a trailer, hauling mowers and equipment all over town. These are the businesses that can be completely derailed by a single accident. They don't have a massive corporate legal team or a deep cash reserve to absorb $1 million lawsuit. Their business vehicle isn't just a tool. It's often the tool that makes everything else possible. That's the person AAA is talking to. To understand their offering, we have to break down what a commercial auto policy actually is. Forget the jargon and the fine print for a moment. At its core, a policy like this is a shield built from several different layers of protection. The first and most fundamental layer, the one that is legally required in nearly every state, is liability coverage. Liability is not for you. It's for everyone else. It's the coverage that pays for the damage you cause to other people and their property. It's broken down into two critical parts: bodily injury and property damage. Let's imagine our electrician, Dave. He's finishing a long day, pulling his work van out of a tight driveway. He's tired, the sun is in his eyes, and he misjudges the turn, scraping the entire side of a brand new, top-of-the-line Mercedes parked on the street. That's property damage liability. It's going to cover the cost to repair or replace that Mercedes. Now let's say the owner of the Mercedes was just about to get into their car when Dave hit it. The impact knocked them off balance, they fell and they broke their wrist. The medical bills, the potential lost wages, the pain and suffering, that's where bodily injury liability kicks in. Now you'll often see liability limits written as three numbers, like 100/300/50. This looks like code, but it's simple. The first number is the maximum amount the policy will pay for bodily injury to a single person in an accident, in this case $100,000. The second number is the maximum total the policy will pay for bodily injury for the entire accident, no matter how many people are hurt, so $300,000. And that third number is the maximum it will pay for all property damage in that accident, so $50,000 for that poor Mercedes. Seeing these numbers, you can immediately understand how the state minimums we talked about earlier are terrifyingly low. That $50,000 property damage limit might not even cover the full repair cost of a modern luxury vehicle. This is the first decision every business owner has to make. How high should the shield be? But liability only covers the other guy. What about your vehicle? Dave's van has a massive dent and a broken taillight. That's where the next layer of the shield comes in. Collision coverage. It's exactly what it sounds like. It pays to repair or replace your vehicle if it's damaged in a collision with another object, whether it's another car, a telephone pole, or a guardrail. It doesn't matter who was at fault. If Dave was 100% at fault for hitting the Mercedes, his collision coverage is what will pay to fix his own van, after he pays his deductible. The deductible is the amount you agree to pay out of pocket before the insurance company starts paying. A higher deductible usually means a lower premium, but it also means more cash you have to come up with after an accident. Okay, so we've covered damage you caused to others and damage to your vehicle from a crash. But what about all the other chaos the world can throw at your business vehicles? This brings us to the third essential layer: comprehensive coverage. This is sometimes called other than collision coverage, and it's the protection against the unexpected. Imagine our catering company. They have their 2 vans parked in their lot overnight. A massive hailstorm rolls through, leaving both vans pockmarked with dents and cracked windshields. Collision coverage won't help them. They didn't collide with anything. But comprehensive coverage will. It's for things like hail, fire, floods, and wind damage. It's also for theft. If someone steals the landscaper's brand new pickup truck from a job site, comprehensive coverage is what will help replace it. If a deer runs out in front of the real estate agent's SUV, that's a comprehensive claim. Vandalism, a tree branch falling on the roof, all covered by comprehensive. For any business whose vehicle is an essential asset, skipping this coverage is like leaving the front door of your business wide open overnight. So we have the big 3: liability, collision, and comprehensive. Together, they form the foundation of a strong policy. They protect others from your mistakes and protect your own assets from both accidents and acts of God. But there's a massive gaping hole we haven't addressed yet. What happens when the accident isn't your fault? You're sitting at a red light, minding your own business, and bam, someone slams into the back of your delivery van. They were texting and driving clearly at fault. The other driver gets out, apologizes profusely, but then drops the bomb. They have no insurance. Or, almost as bad, they have the absolute bare minimum state-required policy, and the damage to your van and your drivers resulting back injury costs far more than their pathetic $15,000 limit. Now what? You could sue them personally, but if they can't afford proper insurance, they probably don't have the assets to cover your damages. You're stuck. This is where the fourth and arguably one of the most critical layers comes into play: uninsured and underinsured motorist coverage. This is coverage you buy to protect yourself from the irresponsible actions of others. If that uninsured driver hits you, your own uninsured motorist coverage steps in and acts as if it were the other driver's liability policy. It will pay for your medical bills and, in some states, the repairs to your vehicle. If the at-fault driver is underinsured, your underinsured motorist coverage will pay the difference between their low limit and the actual cost of your damages, up to your own policy limit. In a country where an estimated 1 in 8 drivers is on the road illegally without insurance, skipping this coverage isn't a gamble. It's a guaranteed future loss. These 4 components: liability, collision, comprehensive, and uninsured/underinsured motorist, are the bedrock of any solid commercial auto policy, and they are the core of what AAA offers. They build the initial fortress around your business. But the real power, the thing that separates a generic off-the-shelf policy from a custom-fit suit of armor, lies in the details. It's found in the specialized endorsements and additional coverages you can add on top of this foundation. Because protecting the vehicle is one thing, but what about the custom $10,000 ladder rack on top of it? What about the $5,000 of catering equipment that was destroyed inside the van during the crash? What happens when you need to rent a replacement vehicle for 2 weeks just to keep your business from grinding to a halt? That's where the next level of protection comes in, and it's where we're going next. These are the questions that keep business owners up at night, because the answer with a basic bare-bones policy is often the one you don't want to hear. You're on your own. Your standard commercial auto liability and physical damage coverages are designed to handle the vehicle itself and the damage it does to others. They are fundamentally not designed to replace the thousands of dollars of specialized equipment you carry inside it. That pipe threader, that diagnostic scanner, those spools of copper wire, they are considered cargo or business property. And when they're destroyed, it's a separate financial catastrophe that your auto policy by itself won't touch. Likewise, the cost of a rental vehicle? That's not automatically included. So while your van sits in a body shop for weeks, the clock is ticking. Every day you can't get to a job site is a day of lost revenue. Your business isn't just paused. It's actively losing money, and your reputation is on the line. But this is not a dead end. This is simply the point where we move beyond the foundational coverages and start customizing the policy to fit the reality of your business. This is where we add the specific tools you need to make your insurance truly work for you. Think of it like this. Liability and physical damage are the chassis and engine of your policy. Now we're adding the custom tool racks, the navigation system, and the heavy-duty suspension. Let's start with that destroyed equipment. The solution here is a type of coverage that often has a strange old-fashioned name: inland marine coverage. Now, don't let the name confuse you. It has nothing to do with boats unless your business involves boats. The term is a relic from centuries ago, when insurance first covered cargo coming off ships and moving inland. Today, it's essentially evolved into coverage for property that is mobile. And for a contractor, a caterer, a photographer, or anyone who carries their tools of the trade with them, it is absolutely non-negotiable. Inland marine coverage can be added to your commercial auto policy as an endorsement, specifically designed to protect your tools and equipment while they are in your vehicle, in transit to a job, or even temporarily at a job site. So let's replay our crash scenario. Your van is totaled. You had, let's say, $12,000 worth of equipment inside. Without inland marine coverage, you are facing a $12,000 bill to re-equip yourself, right after dealing with the headache of a major accident. You'd be paying for that out of pocket, maybe putting it on a high-interest credit card just to get back to work. But with inland marine coverage, the story changes completely. You file a claim. You'll have a deductible. Let's say it's $500 or $1,000. After you pay that, the insurance kicks in to cover the cost to replace the rest of your listed equipment. That $12,000 nightmare becomes a manageable $1,000 problem. You get a check, you go buy new tools, and you're back on the job. It transforms a potential business-ending event into a solvable inconvenience. When you work with an agent from AAA, they're trained to ask about this. They'll ask, "What do you carry in your vehicles? What's the approximate value?" They know that for many businesses, the contents are worth as much, or even more, than the vehicle itself. Okay, so we've replaced the tools, but your van is still a wreck, and the shop says it'll be 3 weeks minimum to get it roadworthy again, if it's not a total loss. This is where the second critical upgrade comes in: rental reimbursement coverage. It's exactly what it sounds like. It helps pay for the cost of a temporary rental vehicle, while yours is being repaired due to a covered claim. This coverage is usually sold with a per-day limit and a maximum number of days. For example, $50 a day for up to 30 days. Now, $50 a day might not cover the full cost of a specialized cargo van, but it makes a massive difference. It turns a potential $2,000 rental bill into a much smaller, more manageable expense. It keeps your business mobile. It allows you to keep your appointments, finish your jobs, and maintain your cash flow. Without it, you're faced with a terrible choice. Either bleed money on a rental you can't afford, or shut down operations and lose even more. Rental reimbursement is the bridge that gets you over that period of downtime without derailing your entire business. But the conversation about replacement vehicles actually opens the door to a much bigger, and arguably more important, area of risk that many business owners completely overlook. This brings us to a powerhouse of a coverage known as hired and non-owned auto liability. This sounds like complex insurance jargon, but let's break it down into two simple real-world scenarios. First, hired auto. Let's say you land a huge project bigger than usual. Your current van isn't big enough to haul all the materials, so you go to a rental company and rent a heavy-duty truck for the week. While driving that rental truck, you cause an accident. Hired auto liability coverage extends the liability protection from your commercial auto policy to that temporary rental. Without it, you'd be relying on whatever minimal coverage the rental agency offers, or your personal insurance, which will almost certainly deny the claim because you were using the vehicle for business. Hired auto coverage ensures you're properly protected. But the second half of this is the one that truly matters, the one that represents a massive hidden liability for almost every small business. That is non-owned auto coverage. Let's imagine your employee, let's call him Dave, is on a job site. He realizes he forgot a specific part. He says, "No problem, boss, I'll just run to the supply store in my own car. Be back in 20 minutes. What could be the harm in that? From an insurance perspective, you have just created a monumental risk. The moment Dave starts driving his personal car for a business purpose, even a quick errand, Your business is now potentially on the hook for his actions. If Dave runs a red light on his way to that supply store and causes a devastating multi-car pileup, who do you think the victim's lawyers are going to sue? They will sue Dave, of course. But his personal auto policy might only have $50,000 or $100,000 in liability coverage. If the damages and injuries are valued at $1 million, where do you think those lawyers are going to look for the other $900,000? They are coming directly for the deep pockets. Your business. They will argue correctly that Dave was acting on behalf of your business at the time of the accident. And without non-owned auto liability coverage, your business is completely exposed. Your business assets, your bank accounts, everything you've worked to build could be seized to pay that judgment. Non-owned auto liability is the shield that protects your business in this exact scenario. It provides liability coverage for your business when an employee is driving their own vehicle for company business. It's one of the most important and surprisingly affordable coverages a business can buy, and the risk it covers is everywhere. Do you ever send someone to the post office? To pick up lunch for the crew? To meet a client? To run to the bank? Every single one of those errands is a non-owned auto risk. A good insurance provider, like AAA, understands that your risk doesn't stop with the vehicles that have your logo on the side. They see the bigger picture. They know to ask how your employees get around and if they ever use their personal vehicles for work. They identify these hidden risks and explain why a simple endorsement for hired and non-owned auto isn't just an upsell. It's a fundamental piece of armor for protecting your entire livelihood. So, to recap, we've moved beyond the basics. We've established that the tools inside the vehicle need their own protection, called inland marine. We've seen how rental reimbursement can save your cash flow by keeping you on the road after an accident. And we've uncovered the massive hidden risk of employees using their personal cars for work, and how hired and non-owned auto coverage is the essential shield against it. With these protections in place, your business is far more resilient. You're no longer just covered for the basics. You're prepared for the realities of running a business in the real world. But we've spent all this time talking about what happens when an accident is your fault. What happens when it's the other way around? What happens when a distracted driver with no insurance, or the absolute state minimum coverage, plows into your brand new $30,000 work truck, sending you to the hospital and totaling your vehicle? Now who pays? How do you protect yourself from the financial fallout caused by someone else's irresponsibility? That's a critical question, and it's exactly where we're heading next. The answer to that question isn't found in the other driver's empty wallet or their bare bones state minimum policy. The answer, the shield that stands between your business and financial ruin, is found within your own policy. It's a specific type of coverage that most people glance over, not realizing it's one of the most critical pieces of armor you can have. We're talking about uninsured and underinsured motorist coverage. Let's call it UM/UIM for short. Think of it like this. When you buy insurance, you're betting that if something bad happens, the system will work. The person at fault will have insurance, their company will pay, and you'll be made whole. But what happens when you're hit by someone operating outside that system? Someone who is legally and financially a ghost. In that moment, your UM/UIM coverage transforms. Your own insurance company, in this case AAA, steps into the shoes of the insurance company the at-fault driver should have had. They become your advocate and your financial backstop against someone else's negligence. Let's break down the two parts of this hero coverage, starting with the most important: your health. Uninsured motorist bodily injury, or UMBI, is the coverage that pays for your medical bills and the medical bills of your passengers when you're hit by an uninsured driver. Let's go back to that crash scene. You're in the ambulance, the hospital runs tests, you need surgery on your arm, followed by weeks of physical therapy. The bills start piling up. We're not talking a few $1,000s. A serious injury can easily climb into the tens, even hundreds of thousands of dollars. Who pays for that? Your health insurance might cover some of it, but you'll likely have high deductibles and copays. And what about the wages you lost because you couldn't work your construction job or run your delivery route for 2 months? That's thousands of dollars of income just gone. This is where UMBI steps in. It's designed to cover those exact expenses: the hospital bills, the ambulance ride, the cost of rehabilitation, and critically, your lost income. It fills the terrifying financial void left by the irresponsible driver. Now, what about the underinsured part? This is just as dangerous and frankly far more common. The other driver has insurance, but they only bought the absolute minimum required by the state. In many states, that minimum liability for injuring someone might be just $15,000 or $25,000. Sounds like a lot of money until you spend one night in an emergency room. That $25,000 is a drop in the bucket compared to a $100,000 medical nightmare. Once their tiny policy limit is exhausted, you're left with a $75,000 gap. You could try to sue the driver personally, but let's be realistic. If they could only afford minimum coverage, they likely don't have $75,000 in assets sitting around. You can't get blood from a stone. This is where underinsured motorist bodily injury coverage saves the day. It kicks in after the other driver's insurance pays out its maximum, and it covers the remaining difference, up to the limits you selected for your own policy. It's gap insurance for your physical well-being. So you've taken care of your body, but what about your business's most vital tool? Your truck, your van, your car, it's a twisted wreck. This is where the second half of our hero coverage comes in. Uninsured motorist property damage, or UMPD. This coverage specifically pays to repair or replace your vehicle when it's damaged by a known uninsured driver. Now you might be thinking, wait, doesn't collision coverage do that? And you're right, it does. But there are two huge reasons why UMPD is still your best friend in this scenario. First, your UMPD deductible is often significantly lower than your collision deductible. Saving $500 or $1,000 on a deductible is a big deal when you're already stressed and losing income. Second, and this is crucial for many small businesses trying to keep costs down, you might not even have collision coverage, especially on an older, paid-off work truck. Many business owners opt out of collision to save on their premium. If that's you and you get hit by an uninsured driver, UMPD is the only thing that will pay to fix your truck. Without it, you're paying for a new vehicle entirely out of pocket, at the worst possible moment. And we have to talk about the most infuriating scenario of all, the hit and run. The other driver doesn't just lack insurance, they lack a conscience. They slam into your parked van overnight or sideswipe you on the freeway and speed off into the night. They become a phantom. You're left with the damage, the police report, and a whole lot of anger. In the eyes of your insurance policy, a phantom driver is treated as an uninsured driver. This is where your UM/UIM coverage becomes your only line of defense. It's the safety net for the ultimate act of driving irresponsibility. When you're navigating this kind of claims process, having a partner like AAA is invaluable. Their process is designed to handle these complex situations. Instead of you having to chase down a ghost driver or fight with a tiny insurance company for their last dollar, you're dealing with your own provider. You're dealing with the company you chose and trust. They handle the subrogation, that's the fancy legal term for them going after the at-fault party to try and recoup the money. That becomes their battle, not yours. Your focus can remain on what's most important: recovering your health and getting your business back on the road. Let's put this into a real-world context. Imagine you're a florist. You have a beautiful custom-wrapped delivery van. It's your mobile billboard and the lifeblood of your business. On the way to a wedding, someone runs a red light and T-bones you. They're a college kid driving a beat-up sedan and you guessed it, no insurance. Your van is totaled. The flowers are ruined. You're okay but shaken and you can't make the delivery. Without UM/UIM, your business is instantly paralyzed. You have no van. You have to cancel upcoming orders. Your reputation takes a hit. You're scrambling to find cash for a down payment on a new vehicle, all because of someone else. Now let's rewind that scene, but this time you have a solid AAA commercial auto policy with strong UM/UIM limits. You make one call. Your UMPD coverage kicks in immediately to pay you for the value of your totaled van, getting you cash in hand to go vehicle shopping right away. Because you also had UMBI, the policy covers your visit to the urgent care center to get your neck checked out. The claim is with a company you know, the process is clear, and within days, not months, you're on your way to getting back to business. That's the difference. It's the difference between a bump in the road and the end of the road for your business. Choosing your UM/UIM limits is one of the most important decisions you'll make on your policy. The golden rule is simple. You should carry UM/UIM limits that are at least equal to your own bodily injury liability limits. Why? Because you are, in effect, insuring yourself against the worst-case scenario. You're deciding how much your own health, your own income, and your own well-being are worth. You wouldn't protect a stranger for $500,000 but only protect yourself and your family for $25,000. You are just as valuable as the person you might accidentally hit, and your coverage should reflect that. So you've protected yourself from the phantom driver and the underinsured. You've built a fortress around your health and your assets from the negligence of others. But what about the threats you can't see coming? The deer that leaps from the woods at dusk, The freak hailstorm that turns your pristine truck into a golf ball. The fire that consumes your garage with your van inside? These events have no one to blame. It's just chaos. How do you protect your business from chaos itself? That requires a different kind of shield, and we're going to build it piece by piece in the next part. This shield isn't forged from steel or iron. It's built from two fundamental, powerful concepts in the world of insurance: comprehensive and collision coverage. Now I know what you're thinking. Oh great, more insurance jargon. But I promise you, by the end of this, you won't just understand these terms. You'll see them for what they really are. The twin guardians that stand between your business and total financial ruin from the unexpected. Let's step away from abstract ideas and into the real world. Meet Maria. Maria runs a high-end catering business called The Gilded Spoon. Her pride and joy isn't just her 5-star recipes. It's her custom-fitted, refrigerated Mercedes-Benz Sprinter van. This van is her mobile command center. It has specialized shelving for delicate pastries, a temperature-controlled unit that costs more than my first car, and a beautiful, expensive wrap on the outside with her elegant logo. This van isn't just a vehicle. It's the heart of her operation. Without it, The Gilded Spoon doesn't exist. One Tuesday night, Maria parks her van in its usual spot in the secured lot behind her commercial kitchen. A storm rolls in. Nothing unusual for a spring evening. But this storm is different. It carries with it a ferocious freak hailstorm. Golf ball-sized chunks of ice rain down for 10 solid minutes. The next morning, Maria walks out to a scene of pure devastation. The van looks like it's been worked over with 1,000 ball-peen hammers. Every single body panel is dented. The windshield is a spiderweb of cracks. The custom wrap is shredded. The vehicle is a wreck, functionally totaled by the insurance adjuster. And here's the critical part. Who is at fault? Nobody. You can't sue the weather. The security company for the lot isn't responsible for acts of God. The van manufacturer isn't to blame. This is pure, unadulterated chaos. This is precisely where the first part of our shield, comprehensive coverage, steps in. Think of it this way: liability insurance, which we covered before, is all about damage you cause to others. Collision and comprehensive are about protecting your own vehicle. Comprehensive, sometimes called other than collision, is your shield against virtually every kind of physical damage that isn't a direct result of a crash. It's for the chaos. It's for the hail that destroys Maria's van. It's for the tree branch that falls on your parked pickup truck during a windstorm. It's for the deer that darts out of the woods and you hit it, causing thousands in damage. It's for the thief who steals your entire van from a job site. Or the vandal who decides to spray paint your logo. Fire, floods, earthquakes, riots. All of this falls under the protective umbrella of comprehensive coverage. It's the ultimate defense against the universe's random, unpredictable moments. For Maria, her AAA commercial auto policy with comprehensive coverage was a business lifesaver. After the initial shock, she made a call. The claims process started. An adjuster assessed the damage, and the policy kicked in to cover the cost of replacing her specialized, expensive van. The chaos came, but the shield held. Her business was bruised but not broken. Now let's look at the other half of the shield: collision coverage. This one is more straightforward but no less vital. As the name implies, collision covers damage to your vehicle when it collides with something else. Another car, a telephone pole, a guardrail, a building. It even covers rollovers. Let's imagine a different scenario for Maria. A week later, with her new van, she's driving to a wedding reception. She's navigating a tight downtown street. A car cuts her off unexpectedly. She swerves to avoid it, but in doing so, she clips a fire hydrant and scrapes the entire passenger side of her brand new van against a brick wall. It's a gut-wrenching sound. The damage is extensive. In this case, it was a collision. And here's the most important thing to understand about collision coverage. It pays for the repairs to your vehicle, regardless of who is at fault. If the other driver was 100% at fault, their liability insurance would pay for your repairs. But what if they were uninsured? What if they fled the scene in a hit and run? What if, like in this case, the fault is murky or even entirely your own? You swerved. Maybe you overcorrected. Without collision coverage, Maria would be paying for those tens of thousands of dollars in repairs out of her own pocket. Her business's cash flow would be crippled. But with collision coverage, she makes a claim and the policy takes care of it. So let's recap the shield. Comprehensive protects you from chaos, theft, weather, animals, vandalism. Collision protects you from crashes, hitting another object or car, regardless of fault. Together, they provide what's often called full coverage for your vehicle itself. They ensure that your most critical business asset, the machine that gets you to your clients and allows you to do your work, is protected from almost any physical harm imaginable. But now we have to address the elephant in the room, the cost. You're hearing all this and thinking, okay, a shield against chaos sounds great, but it also sounds expensive. And this is where we need to talk about one of the most misunderstood, yet powerful tools you have for controlling your insurance costs, your deductible. A deductible is simply the amount of money you agree to pay out of pocket for a claim before your insurance coverage begins to pay. Think of it as your share of the risk. For both comprehensive and collision, you choose your deductible amount. Common options are $500, $1,000, or even $2,500. Here's the trade-off, and it's a strategic business decision. A lower deductible, say $500, means that if you have a claim, you'll only have to pay a small amount yourself before the insurance company covers the rest. But because the insurer is taking on more risk, your monthly or annual premium will be higher. Conversely, a higher deductible, like $2,500, means you're accepting more of the initial risk. If you have a claim, you'll have to come up with that larger amount first. But because you're taking on more of that risk, the insurance company will reward you with a significantly lower premium. Let's go back to Maria's hailstorm-damaged van, which was valued at $80,000. Let's say she chose a $1,000 deductible for her comprehensive coverage. When the van was declared a total loss, she paid the first $1,000. Her AAA policy then paid the remaining $79,000 to allow her to get a new one. If she had chosen a $2,500 deductible, her premium would have been cheaper all along, but in this moment of crisis, she would have paid $2,500 and the policy would have covered $77,500. There's no single right answer. A business with a healthy emergency fund might opt for a higher deductible to save money on premiums year after year. A newer business, operating on tighter margins, might prefer a lower deductible for the peace of mind of knowing that a smaller, more manageable out-of-pocket expense is all that stands between them and getting back on the road. When you work with a provider like AAA, their agents can help you run the numbers and see how different deductible levels impact your premium, allowing you to make the smartest financial choice for your specific situation. So we've built the shield. Comprehensive and collision coverage are in place. Maria's van, whether damaged by hail or a brick wall, is covered. The asset itself is protected. She gets the check, she can buy a new van. It seems like the problem is solved, right? But it isn't. There's a hidden danger here, a second-order effect of the chaos that can be just as deadly to a business. The check for the van might take a few days to process. Finding and purchasing a new, specialized refrigerated van isn't like buying a sedan off a lot. It could take weeks, even months, to find the right one and get it customized. During all that time, Maria is grounded. She has no van. That means no deliveries, no catering for weddings, corporate events, or private parties. She has to cancel jobs, losing not just income but also her hard-won reputation. The shield protected her property, but her entire stream of revenue has just been cut off. The heart of her business was saved, but the business itself is now bleeding out. How does a business survive when its most essential tool is sitting in a repair shop or a salvage yard for a month? How do you keep the lights on when you literally can't get to the job? This is the silent killer of small businesses. It's not the big explosive lawsuit that makes the headlines. It's the slow, quiet bleed out. It's the sound of the phone ringing with a customer who needs you, and you having to say, "I'm sorry, I can't." It's the agonizing math you do in your head every single night, calculating the jobs you lost that day, the income that vanished, the bills that are still piling up. For our electrician Mark, this wasn't a hypothetical. His van, the mobile headquarters of his entire operation, was a twisted wreck. The other driver's insurance had accepted liability, and his own collision coverage was set to pay for the van itself. He had the right coverage, he thought, but the checks and balances of insurance take time. The adjuster needs to inspect the vehicle, declare it a total loss, process the valuation, and cut a check. This can take weeks, sometimes over a month, and every single day of that month Mark was grounded. He was an electrician with no way to get his tools to a job site. He was losing $1,000, $1,500 a day in revenue. His business was dying on the vine. This is where a single, often overlooked line item on a commercial auto policy becomes the most important coverage you can possibly have. It's called rental reimbursement, or sometimes substitute transportation. And it is the bridge over the valley of financial ruin. Here's how it works. While your commercial vehicle is out of commission due to a covered claim, like Mark's accident, this coverage pays for you to rent a temporary replacement. It's that simple. But the details are what make it a business saver. A typical AAA commercial policy might offer limits like $50, $75, or even $100 a day for up to 30 days. Let's do that math. $100 a day for 30 days is $3,000. $3,000 dedicated solely to keeping your business mobile. Now you might be thinking, $100 a day? What kind of work truck can I get for that? And that is a brilliant question, because it highlights a critical difference between personal and commercial insurance. If your personal Honda Civic is in the shop, renting another sedan is easy. But if you're a plumber, you can't run your business out of a Nissan Sentra. You need a cargo van. If you're a landscaper, you need a pickup truck with a bed for your mowers. This is where a specialized commercial provider like AAA shines. They understand that you need a vehicle of like kind and quality. Their network and their policies are designed to get you into a comparable work vehicle, not just any four-wheeled box. That $3,000 isn't for a vacation rental. It's a direct investment in your business continuity. Imagine Mark's situation again, but this time he had paid the extra, maybe $10 or $15 a month, for robust rental reimbursement coverage. The day after the accident, instead of sitting at his kitchen table staring at a pile of bills, he's on the phone with the rental company. By that afternoon, he's loading his spare tools into a rented Ford Transit van. The very next morning, he's back on the road, back on the job site, back to earning a living. He's still dealing with the hassle of the totaled van, sure, but the business itself hasn't stopped. The cash flow hasn't been choked off. That small monthly premium didn't just buy him a rental. It bought him survival. It's the difference between a major inconvenience and a potential bankruptcy. But this idea of using vehicles you don't own to keep your business running opens up a whole new can of worms. It exposes two of the most common and dangerous liability gaps that most business owners don't even know they have. Let's talk about hired and non-owned auto coverage. This sounds like complicated insurance jargon, but I promise you it's terrifyingly simple. Let's stick with Mark. A month after he's back on his feet with a new van, he lands a huge contract, installing the lighting for a new parking lot. The job requires a bucket truck to reach the tall poles, but he doesn't own one. So, he does what any smart contractor would do. He hires one for the week. He signs the rental agreement, picks it up, and drives it to the job site. On the way, he misjudges a turn and clips another car, causing a serious accident. Now who pays? You might think the rental company's insurance covers it. Wrong. You might think Mark's standard commercial auto policy covers it. Wrong again. His policy covers the specific vehicles listed on it. His work van. It does not automatically cover a 10-ton bucket truck he rented for a week. The moment he signed that rental agreement and got behind the wheel, he exposed his entire business to a massive uncovered lawsuit. The other driver isn't going to sue the rental company. They're going to sue Mark's electrical business. And without the right coverage, that lawsuit could take everything. This is what hired auto coverage is for. It's a specific endorsement that extends your liability protection to vehicles that you rent, hire, or borrow for your business. It transforms your policy from just covering your van to covering your business operations, no matter what vehicle is being used. For the tiny cost of adding this coverage, Mark would have been fully protected. The accident would be a headache, but not a business-ending catastrophe. That's hired auto. Now for its even more insidious cousin, non-owned auto coverage. This one is so common, so everyday, that I guarantee nearly every business owner watching has this exposure and many don't even realize it. Non-owned auto coverage protects your business when an employee uses their own personal vehicle for business purposes. Think about that for a second. Have you ever asked your office manager to run to the post office or the bank in their own Toyota Camry? Have you ever sent a technician to Home Depot to pick up a box of screws in their personal Ford F-150? Have you ever paid for a pizza lunch and had it delivered by one of your guys who drove his own car to go get it? If you answered yes to any of those, you have a non-owned auto exposure. Let's play it out. Your best employee, Sarah, is driving her own Honda CR-V to the bank to deposit the day's checks. She gets distracted, runs a red light, and T-bones another car, causing serious injuries. The first person Sarah's insurance company is going to call is her employer. You. Why? Because she was engaged in a business task, in the course and scope of her employment, when the accident happened. The lawyers for the injured party won't just sue Sarah. They will absolutely sue your business because your business has deeper pockets. It's called vicarious liability. And here's the terrifying part. Sarah's personal auto policy will likely deny the claim. Most personal policies have an exclusion for business use. And your standard commercial auto policy? It won't respond either because Sarah's CRV isn't a vehicle you own. It's not listed on your policy. So you, the business owner, are left completely exposed, facing a potentially multi-million-dollar lawsuit with zero insurance coverage. All because you asked an employee to run a simple errand. Non-owned auto coverage is the shield that protects you in exactly this scenario. It's an inexpensive endorsement that says if an employee gets into an accident while using their own vehicle for your business, your commercial policy will step up to defend the business and pay the liability claim. It closes one of the most deceptively dangerous loopholes a business can have. So you see, it's not just about the van. It's about the entire ecosystem of how your business uses vehicles. The collision and comprehensive coverage rebuilds your truck. The rental reimbursement keeps you on the road while it's being rebuilt. And the hired and non-owned coverage protects your business from the risks you take on every time you rent a vehicle or an employee runs a simple errand. Together, they create a fortress of protection that allows a business to survive not just the primary accident, but all the secondary shockwaves that come after. So Mark gets his rental van. He's back on the road, making money, keeping his business alive thanks to that crucial coverage. His business is protected from weird liability gaps. He made it. He survived. But as he's driving to that new job, he looks in the back of the nearly empty rental van, and a new cold wave of dread washes over him. What about the $10,000 worth of specialized diagnostic tools, the $3,000 in copper wiring, and all the expensive power tools that were in his original van? The tools that were mangled, destroyed, or stolen from the wreck at the tow yard. Are those covered by his auto policy? The answer is almost certainly not. And understanding why opens up a whole new dimension of risk we haven't even touched yet. This is a devastating business-ending moment for our plumber John, because a commercial auto policy is designed to cover the vehicle itself, the chassis, the engine, the body, the things that are permanently attached to it. It's insurance for the auto part of commercial auto. The tools, the equipment, the inventory, the very things that allow John to actually be a plumber, are considered business personal property. Or, in insurance terms, they're often thought of as cargo. The vehicle's job is to transport that cargo from one place to another. And the standard auto policy doesn't cover the cargo, it covers the transporter. This is one of the most common and catastrophic gaps in coverage for any tradesperson, contractor, or mobile business owner. They assume that because the tools are in the work van, they're part of the work van's insurance. It's a logical assumption, but it's a wrong one. And that one wrong assumption can bankrupt a business overnight. So, how do you protect against this? How does John get his $10, $20, maybe even $50,000 worth of tools covered? The answer lies in a different kind of policy, one with a strange and frankly confusing name: inland marine insurance. Now, when you hear the word marine, you're probably thinking of boats, oceans, and shipping containers. And you're not wrong. That's where it all started. Centuries ago, marine insurance was created to cover ships and their cargo as they crossed the ocean. It was one of the first forms of modern insurance. But as trade and commerce moved inland, via railways, then canals, and eventually trucks, a new type of risk emerged. Goods were no longer just on the ocean. They were moving across land. Insurers needed a way to cover this property in transit, so they adapted their marine policies and called the new creation inland marine. It's a historical name that stuck, but what it really means today is property in transit, or property that is mobile. It's insurance for things that don't just sit in one building. And John the plumber's tools are the absolute perfect example. They are rarely in his shop. They live in his van, they're carried onto job sites, they move around constantly. They are, by definition, inland marine property. Under an inland marine policy, you can get a specific type of coverage often called a contractor's equipment floater, or simply tools and equipment coverage. This policy is designed to do exactly what John's commercial auto policy won't. It protects his tools and equipment from perils like theft, fire, and critically in this case, damage from a vehicle collision. Let's break down exactly what this means for John's wrecked van. Imagine we're the insurance adjuster looking at the scene. First, we look at the van itself. The crumpled fender, the shattered windshield, the bent frame. That's all covered by the commercial auto policy's physical damage coverage, assuming he has it. Now, John had custom steel shelving bolted directly to the floor and walls of his van. Because that shelving is permanently installed, it's generally considered part of the vehicle. So, the auto policy would likely cover the cost to replace that shelving too. But then we look at what was on those shelves. The pipe threader, the drain snake, the collection of power drills, the diagnostic camera. These items were just sitting there, maybe strapped down but not permanently affixed. They are John's mobile equipment. The commercial auto policy says, "Not my problem." But the inland marine policy says, "This is exactly my problem." With this separate coverage, John can file a claim to get the money to replace that essential equipment. Without it, he's paying out of pocket. This isn't just for plumbers. Think about it. A landscape contractor with thousands of dollars in mowers, blowers, and trimmers on a trailer. A photographer driving to a wedding with a car full of cameras, lenses, and lighting gear. A mobile DJ with turntables, speakers, and a laptop. A food truck owner whose entire kitchen, the grill, the fryer, the fridge, is on wheels. In every single one of these cases, a standard commercial auto policy covers the vehicle, but it does not cover the expensive, revenue-generating equipment inside it. All of them need some form of inland marine or tools and equipment coverage. Now let's dig a little deeper because not all of these policies are created equal. When you're looking at this kind of coverage, there are two massively important terms you need to understand. Replacement cost versus actual cash value. Actual cash value, or ACV, pays you for what your property was worth at the exact moment it was destroyed. It takes the original price and then subtracts depreciation for age and wear and tear. So John's 5-year-old pipe threader that he bought for $2,000 might only have an ACV of $800 today. He'll get a check for $800, but he can't buy a new one for that. He'll have to find a used one or pay the difference out of his own pocket. Replacement cost, or RC, is different. It pays you the cost to replace your old item with a brand new, similar item at today's prices. So, if that same pipe threader costs $2,500 to buy new today, John gets a check for $2,500. For any business owner, replacement cost coverage is almost always the better choice. It's the difference between getting back on your feet quickly and struggling to piece your business back together with used or inferior equipment. Another key detail is whether your property is scheduled or unscheduled. Unscheduled coverage is a blanket limit for all of your tools. For example, John might have a policy with a $20,000 blanket limit for all of his tools, with maybe a cap of $2,000 for any single item. This is great for covering all the miscellaneous hand tools and smaller power tools. But what about that really expensive piece of gear? Let's say John has a $5,000 sewer jetter. If his unscheduled limit per item is only $2,000, he'd be short $3,000 if it was destroyed. That's where scheduling comes in. You can specifically list or schedule high-value items on the policy with their serial number and an agreed-upon value. This ensures that your most expensive critical pieces of equipment are fully covered, with no surprises. So, the conversation with a good insurance agent from a provider like AAA shouldn't just stop at, "What kind of truck do you have?" It has to go further. It has to be, "Okay, you have the truck. What's in the truck? What's its value? How critical is it to your daily operations?" Let's make sure the business that operates out of the vehicle is just as protected as the vehicle itself. This is the advisory role that separates a great agent from a simple order taker. They identify the gaps you don't even know you have. For John, the plumber, this is the difference between a terrible inconvenience and total financial ruin. The accident was bad enough, but discovering that the tools that represent his entire livelihood have vanished with no insurance to replace them is a second, more devastating crash. He's now facing the cost of his auto policy deductible, the potential for his rates to go up, and now the soul-crushing cost of rebuying every single tool he needs to earn a living all at once. And believe me, his problems are just getting started. We've been focused on John's own property, his van, his tools. We've completely ignored the other side of this accident, the other car he hit, the driver who is now being put on a stretcher and loaded into an ambulance. While John is frantically trying to figure out how he'll pay for $10,000 or $20,000 in tools, a certified letter is already being drafted by an attorney. A letter that will demand payment not for thousands, but for hundreds of thousands or even millions of dollars in medical bills, lost wages, and pain and suffering. And whether his insurance policy is a shield that protects him or a piece of paper that fails him depends entirely on the liability limits he chose. Let's break down exactly what those liability limits mean. Using Mark's situation as our guide, think of a standard commercial auto policy like one from AAA as having 3 key numbers for liability: You might see something like 100/300/50. This isn't just random insurance jargon. It's the blueprint for your financial survival after a crash. The first number, 100, stands for $100,000. This is the absolute maximum the insurance company will pay for bodily injury to a single person in an accident you cause. So, if one person in that minivan has medical bills, lost wages, and pain and suffering totaling $150,000, a policy with this limit would pay the first $100,000. Mark would then be personally sued for the remaining $50,000. The second number, 300, stands for $300,000. This is the maximum the policy will pay for bodily injury for the entire accident, no matter how many people are hurt. In Mark's crash, there were a mother, a father, and 2 children in the minivan. Let's say 3 of them were seriously injured. Even if each of their claims was a valid $100,000, the policy would only pay a total of $300,000 for all of them combined. Anything above that? Again, that's a lawsuit aimed directly at Mark's business and personal assets. The third number, 50, represents $50,000. This is the maximum the policy will pay for property damage. This covers the other vehicle, the minivan. If it's a newer model, $50,000 might not even be enough to replace it. It also has to cover damage to anything else, like a destroyed guardrail, a broken storefront, or personal property inside the other car. If the minivan was worth $60,000, Mark is on the hook for the $10,000 difference. Now imagine for a moment that Mark, trying to save a few dollars a month, had only purchased the state-mandated minimum liability coverage. In many states, this is shockingly low, something like 25/50/25. $25,000 for one person's injuries, $50,000 total for everyone's injuries in the accident, and $25,000 for property damage. Let's run the numbers on that nightmare scenario. The minivan is totaled, a $60,000 loss. Mark's policy only covers $25,000. He is immediately $35,000 in the hole just for the vehicle. Now the people. The father has a broken leg and a concussion. His medical bills and lost time from work amount to $80,000. The mother has severe whiplash and requires months of physical therapy, a $40,000 claim. One of the children, thankfully, only has minor bruises, but the emergency room visit and checkup still costs $5,000. The total for bodily injury is $125,000. Mark's 25/50/25 policy will pay the father $25,000, the maximum for one person. It will pay the mother $25,000. Since the policy's total limit for the entire accident is only $50,000, that's it. The well is dry. The child's $5,000 bill isn't covered at all. The family is now short $75,000 for their medical care, plus the $35,000 for their destroyed van. They are facing a $110,000 shortfall. Who pays for that? Mark does. The family's attorney will file a lawsuit not just against Mark's Landscaping LLC, but against Mark personally. The first thing they'll do is put a lien on his business assets. His new F-250, the trailer, the expensive zero-turn mowers, all of it could be seized and sold off. If that's not enough to cover the judgment, they'll go after his personal assets, his savings account, his investments, even the equity in his family's home. The business he spent a decade building, the dream he poured his sweat and soul into, could be dismantled and liquidated in a matter of months, all because he tried to save maybe $50 or $100 a month on his insurance premium. That is the brutal reality of being underinsured. Now let's rewind the clock. Let's imagine a different path for Mark. When he first started his business, instead of just buying a policy online to check a box, he sat down with an experienced agent like one from AAA. This agent didn't just sell him a product, they asked questions. They learned about his business, the equipment he hauls, the areas he drives in, and his plans for growth. The agent explained that the state minimum isn't a recommendation. It's a legal floor, and it's a terrifyingly low one for any serious business. The agent would have presented him with much higher, more realistic options. Maybe $250/500/100. Or even better, they might have recommended a combined single limit, or CSL, policy. This is often a superior choice for businesses. Instead of splitting the coverage into those 3 separate buckets for bodily injury and property damage, a CSL policy provides one large pool of money. A $1 million CSL policy, for example, gives you a $1 million fund that can be used in any combination needed to cover damages from a single accident. Let's replay the accident one last time, but now Mark has that $1 million combined single limit policy from AAA. The crash happens. It's just as terrifying, just as awful. But what happens next is completely different. The $60,000 minivan is totaled. His AAA policy pays for it. The $125,000 in medical bills for the family? His AAA policy pays for all of it. The family's attorney sees that Mark has a robust, high-limit policy. There's no need for a protracted, devastating lawsuit against Mark personally. The insurance is sufficient to make the injured family whole again. The claims are handled by AAA's adjusters. The bills are paid. Mark's business is protected. His personal assets are untouched. His home is safe. Yes, his premium will likely go up at renewal. He may even have to pay his deductible, but his business survives. He gets to keep working, keep employing his crew, and keep serving his customers. He gets to recover. The difference between these two outcomes isn't luck. It's a single decision made months or years before the accident ever happened. It's the decision to view insurance not as an annoying expense, but as an essential investment in the survival of your business. The cost difference between a policy that bankrupts you and a policy that saves you is often just a fraction of your monthly fuel bill. Choosing the right liability limit is the single most important decision you will make when buying commercial auto insurance. It's the foundation upon which your entire financial safety net is built. But what happens when the other driver is the one at fault? What if they're the one who runs the red light and plows into your brand new work truck? Mark's liability coverage saved his business from claims made by others, but it does absolutely nothing to fix his own truck or pay for his own injuries. For that, we have to look at an entirely different part of the policy. And this is where we uncover the truth about protecting your own assets, your vehicle, and your own well-being, even when the accident isn't your fault at all. So far, we've built a fortress of liability protection for our contractor, David. We've shielded his business from lawsuits, covered the other driver's wrecked car, and paid for their medical bills. But in all of this, David is still standing on the side of the road, looking at his crumpled work truck. His arm is throbbing, and he's realizing a terrifying truth. None of the coverage we've discussed so far pays him a single dime. Not for his truck. Not for his own medical bills. Not for the weeks of work he's about to lose. This is the most common and most dangerous misunderstanding in all of insurance. People assume that if the other driver is at fault, their insurance will simply take care of everything. But what if that driver, who just ran a red light and T-boned you, has no insurance at all? Or what if they have the absolute bare minimum coverage required by the state, which in some places is as low as $5,000 or $10,000 for property damage? That might not even be enough to replace the custom shelving and ladder rack on your van, let alone the van itself. This is where you stop relying on someone else's responsibility and start taking control of your own financial security. This is where we talk about uninsured and underinsured motorist coverage, often abbreviated as UM/UIM. Think of it as buying an insurance policy for yourself on behalf of the irresponsible driver who might one day hit you. It's a shield you carry because you can't trust everyone else on the road to have their own. Let's break it down. First, there's uninsured motorist bodily injury, or UMBI. In our scenario, the other driver who caused the accident was texting and driving, and had let his insurance lapse. He's uninsured. David's arm is broken and he needs surgery. His health insurance might cover some of it, but he has a high deductible and significant copays. More importantly, he's a contractor. A broken arm means he can't work for 6 to 8 weeks. That's 2 months of lost income. UMBI is designed to step in and cover these exact costs. It can pay for his medical bills, his physical therapy, and critically, it can compensate him for the wages he lost because he was unable to work. It protects your body and your income from the negligence of an uninsured driver. Then there's its close cousin, underinsured motorist bodily injury, or UIMBI. This is for a slightly different but equally frustrating scenario. Let's say the other driver did have insurance, but it was the state minimum policy with the $25,000 bodily injury limit. David's surgery, hospital stay, and lost wages add up to $70,000. The at-fault driver's policy pays out its maximum of $25,000, and then that's it. They're done. You're left with a $45,000 gap. If David has UIMBI coverage, his own AAA policy can step in to cover that difference up to his policy limits. Without it, he'd be forced to either sue the driver personally, which is often like trying to get blood from a stone, or eat that massive cost himself. And what about the truck? That's where uninsured motorist property damage, or UMPD, comes into play. If the at-fault driver has no insurance, this coverage can pay to repair or replace your vehicle. It's an essential backstop. However, this brings us to the main event when it comes to protecting your vehicle: physical damage coverage. When you hear someone say they have full coverage, this is what they're usually talking about. It's not an official insurance term, but it generally means you have both liability and physical damage coverage. Physical damage is typically split into two crucial parts: collision and comprehensive. Let's start with collision. This one is straightforward. Collision coverage pays to repair or replace your vehicle if it's damaged in a collision with another object, or if it overturns. The key phrase here is regardless of fault. It doesn't matter if you slid on ice and hit a guardrail, if someone hit you in a parking lot and drove off, or if you were in the accident we described with the uninsured driver. If you have collision coverage, you file a claim with your own insurance, you pay your deductible, and they handle the repairs. The deductible is the amount you agree to pay out of pocket before the insurance company pays the rest. Common deductibles are $500, $1,000, or even $2,500. A higher deductible means a lower premium, because you're taking on more of the initial risk. For David's heavily damaged truck, let's say the repair estimate is $14,000. If he has a $1,000 deductible, he pays the body shop the first $1,000, and AAA pays the remaining $13,000. This is the coverage that gets your vehicle back on the road and your business back up and running as quickly as possible, without waiting for a lengthy fault investigation. Gives you control. But sometimes your business vehicle is threatened by something other than a crash. A thief could steal your van full of expensive tools overnight. A hailstorm could leave it looking like a golf ball. A deer could jump out on a dark road. None of these are collisions in the traditional sense. For these events, you need comprehensive coverage. Think of comprehensive as other than collision coverage. It protects your vehicle from almost everything else: fire, theft, vandalism, falling objects like a tree branch, floods, animal strikes. This is the stuff you can't predict or avoid. For a business owner, this is non-negotiable. Your work truck or van is a rolling billboard and a mobile office. Imagine waking up to find it stolen. Not only are you out of a vehicle, but you may have lost thousands of dollars in tools and equipment inside. Comprehensive coverage pays for the value of the vehicle itself, getting you the capital to replace it and get back to work. When you make a collision or comprehensive claim, the insurance company will pay up to the actual cash value, or ACV, of your vehicle. This is another critical term to understand. ACV is not what you paid for the truck. It's what your truck was worth the moment before the loss occurred. It accounts for depreciation, mileage, and condition. So a 5-year-old work truck with 150,000 miles on it will have a lower ACV than a brand new one. Understanding this helps set realistic expectations for what you'll receive in a total loss scenario. But just having these coverages isn't the end of the story. The real value comes from thinking about what happens during the claim. Your truck is damaged. It's going to be in the shop for 3 weeks. How do you run your business? You can't exactly haul lumber and ladders in a compact rental car. This is where you add a small but mighty coverage called rental reimbursement. For just a few extra dollars per month, if you have a covered claim under comprehensive or collision, your policy will pay for a rental vehicle while yours is being repaired. AAA's commercial policies are designed for this, allowing you to get a rental truck or van that's suitable for your work, up to a certain daily and total limit, like $50 a day for a maximum of 30 days. Without this, you're either paying out of pocket for a rental, which can cost thousands, or you're simply not working. And let's not forget towing and labor coverage. It's exactly what it sounds like. If your vehicle breaks down, gets a flat tire, or needs a tow to the shop after an accident, this coverage handles the cost. It's an inexpensive add-on that provides immense peace of mind, ensuring you're never stranded on the side of the highway with a disabled work vehicle. By combining liability, uninsured/underinsured motorist, collision, comprehensive, and these small but vital additions, you create a truly robust policy. You've moved from only protecting others to building a comprehensive shield that protects your business assets, your income, and your own personal well-being. You are no longer at the mercy of other, less responsible drivers on the road. You have a plan. You now understand the architecture of a great commercial auto policy. You know what each piece does and why it's essential. But knowing what to buy is only half the battle. When disaster strikes, how do you actually use it? What does the claims process really look like, from that first frantic phone call to the moment you get your check or your repaired vehicle back? And more importantly, how can you be sure you're getting every single discount you deserve? There are specific ways to structure your policy and your business that can unlock savings most people never even know exist. Let's start with the most powerful lever you can pull: bundling. Now, everyone knows about bundling personal auto and home insurance, but in the commercial world, this goes so much deeper. We're not just talking about adding your personal car to the policy. We're talking about creating an entire fortress of protection around your business with a single carrier. Think about your business owner's policy, or BOP. This often combines your general liability and your commercial property insurance. When you bundle your commercial auto policy with your BOP through AAA or its affiliated carriers, the discount isn't just a nice little bonus. It can be substantial. Why? Because from the insurer's perspective, you've gone from being a single policy customer to a deeply integrated partner. You're less likely to switch carriers for a minor price difference, which makes you a more valuable, long-term client. Insurers reward that loyalty. But don't stop there. Do you have a commercial property policy? A general liability policy? Workers' compensation? Ask your AAA agent to conduct a full review of every single business policy you hold. The goal is to see how many of them can be consolidated. Each policy you bring under one roof can potentially add another layer to your discount, creating a compounding effect on your savings. This is the difference between thinking like a consumer and thinking like a CEO. A consumer buys a policy. A CEO builds a strategic insurance portfolio. Next, let's transform your biggest risk, your drivers, into your biggest source of savings. Most business owners see driver safety as a cost, a headache of training and monitoring. But the smartest owners see it as an investment with a direct return. It starts with a formal written safety program. This isn't just a piece of paper you file away. It's a living document that outlines your company's rules of the road, policies on cell phone use, procedures for pre-trip vehicle inspections, and protocols for what to do after an accident. Having this formal program in place can itself trigger a discount with many carriers, including AAA, because it signals that you are a proactive, risk-aware business. But you have to back it up with action. This is where telematics comes in. These are the small devices or even smartphone apps that monitor driving behavior, things like hard braking, rapid acceleration, speeding, and time of day. For years, business owners feared these devices, thinking drivers would see it as Big Brother. But the narrative is changing. When you frame it correctly, it's about safety, not surveillance. It's about protecting your drivers, your vehicles, and the public. And the data is undeniable. Businesses that use telematics see a dramatic reduction in accidents. AAA knows this, and they often provide significant discounts, sometimes up to 30%, for businesses that effectively implement a telematics program. It's a pure win-win. You create a safer fleet, reduce your accident risk, lower your fuel and maintenance costs, and get a massive discount on your insurance premium. Another proactive step is continuous MVR monitoring. That's motor vehicle record. Instead of just pulling a driver's record once when you hire them, you use a service that alerts you in near real time if one of your drivers gets a speeding ticket, a DUI, or any other violation. This allows you to intervene immediately with coaching, training, or disciplinary action before that driver becomes a major liability. Implementing this kind of program is another powerful signal to your insurer that you are serious about managing risk, and it can absolutely influence your rates. Now let's talk about the claims process. When an accident happens, the first hour is the most critical. Your driver is shaken, traffic is a mess, and the clock is ticking. This is where your safety program pays off. Your driver should know the protocol by heart. First, ensure everyone is safe and call 911 if there are any injuries. Second, never ever admit fault at the scene. They can state the facts. The other car came into my lane. But they should not say, "I'm sorry," or "it was my fault." That is a legal determination, not a roadside diagnosis. Third, use their phone to become an expert documentarian. Take photos of everything. All four corners of every vehicle involved, the license plates, the damage up close and from a distance, the road conditions, the traffic signs, any skid marks. Get a picture of the other driver's license and insurance card. If there are witnesses, get their names and phone numbers. This evidence is gold. It can be the single factor that determines the outcome of a claim. Once the scene is secure, the call to AAA needs to be made as soon as possible. Have the policy number ready. When you report the claim, be clear, factual, and concise. Stick to what you know, not what you think happened. The person on the other end of the line is there to help, and giving them clear, accurate information starts the process on the right foot. You'll be assigned a claims adjuster. This person is your primary point of contact. Their job is to investigate the claim, determine fault, and assess the damages. Your job is to work with them collaboratively. Be responsive. If they ask for a document, send it promptly. Keep a log of every conversation, the date, the time, who you spoke to, and a summary of what was discussed. This creates a paper trail that protects you and keeps everyone accountable. When it comes to repairs, you generally have two options. You can use a repair shop from AAA's approved network or choose your own. There are pros and cons to each. A network shop has a direct relationship with AAA, which can streamline the payment and approval process. The work is often guaranteed by AAA, which provides peace of mind. However, you always have the right to take it to a shop you trust. If you go this route, make sure the shop is experienced in handling insurance claims. They will need to provide a detailed estimate and work with the adjuster on any supplemental costs that arise once they start taking the vehicle apart. Throughout this entire process, from the first call to getting your vehicle back, your AAA agent should be your advocate. If you feel the process is stalling, if you don't understand a decision, or if you have any concerns, call your agent. They can often get answers and move things along in ways you can't. They are your professional guide through a complex system. Finally, let's wrap all of this together. For the past 9 parts, we've broken down every component of commercial auto insurance. We've gone through liability, physical damage, endorsements, and driver selection. But if there is one single takeaway from this entire series, it is this: commercial auto insurance is not a commodity you buy once a year. It is a dynamic, strategic tool that you must actively manage to protect the business you've worked so hard to build. It's about making conscious choices. It's choosing to build a safety culture not just to get a discount, but because it's the right thing to do and it makes your business stronger. It's choosing the right vehicles with the best safety features, understanding that the sticker price is only the beginning of the vehicle's true cost. It's about building a true partnership with your insurance agent, viewing them as a trusted advisor, not just a salesperson. It's about understanding that the policy itself is just the beginning. Your actions, your procedures, and your company culture are what truly determine your risk and ultimately your cost. So don't just get a quote. Have a conversation. Go to your AAA agent armed with the knowledge from this series. Ask them about bundling your BOP. Ask them about telematics discounts. Ask them to help you benchmark your safety program against others in your industry. Challenge them to find every single discount you are entitled to. By doing so, you're not just buying insurance. You're investing in your company's resilience, its reputation, and its future. You're turning a line item expense into a competitive advantage. And that is how you truly master your commercial auto insurance.